a lot of sections. My primary reference point for this discussion, which we are going to have it today, is a public consultation document, which is issued for UAE corporate tax. And there are question and answers which are being addressed in the Ministry of Finance portal. So I'd given both the references point also as part of the coverage or presentation. Our team is going to share the presentation to you once we are done with the session. So that will be done very soon. Any questions anyone has to start with, or any comments you want to give up before we initiate the conversation? I'm not able to see any chat window. Maybe if there is something, maybe Huda or any administrative team will be able to support on that. I'll take further to the session. To be honest, when I was started preparing this topic, I thought not too much is there on talking about this topic. Okay. If you're not speaking and you don't want to put any comment, maybe you can put yourself on mute, which will be easy for people to follow through. Okay, so this keeps happening in the session, so it's okay. We are into the virtual mode, having a lot of positives, and there are some drawbacks also. But anyway, looking forward to have some physical event soon on this corporate tax topic, because this is quite becoming quite intricacies are getting addressed now. So let's see how we move it on. So I was referring to initially, I thought the topic does not require 3 hours of activity or 3 hours of a session, but definitely when I started building it up, there are a lot of fields which keep coming out of the section when you read it again and again. So that's what happened. And to be honest, this slide or the presentation itself turned out to be 117 slide document. Maybe I'll say 5-10 are indexes, but otherwise still it's 100+ slide document which is going to be there, which we're talking about. So just a quick intro. I'll not take more time. This is just to bring people up the curve, which those who have missed the previous session. So UAE always had a corporate tax, but never had a corporate tax at a federal level. Just to give you an update, there was incomes which were getting taxed from a UAE perspective, but which were more from an Emirates level. There were taxes primarily on the banking sector, which is the foreign banks, and oil extraction companies or oil sector, which is where these taxes were there. But now what is happening now with the help of the corporate tax, which is becoming at the federal level. That means at a country level, this tax will be imposed. And there are sections which says which are the industries which are exempt from this. Those are basically currently getting taxed from a Emirates level. So those are getting eliminated, or you can say exempt from a corporate tax, which is a federal one. Look at will corporate tax will apply to all businesses? The answer is yes, except for extraction of natural resources, which will remain subject to Emirates level corporate tax. So that's what is a highlight. Foreign entities and individuals will be subject to tax. Yes, they will be. Now there is a good debate or good discussion document which has come up. A new terminology, which was referred in the Q&A also, but they have elaborated it quite well, which is permanent establishment. So how that spans out and what it impacts to the foreign entity, that we are going to cover it up in today's session also. And UAE corporate tax will apply equally to all category of profits. That is net profit, income received from financial statement is going to be the starting point. And then there will be adjustments which will be plus minus will be done to arrive at what is going to be a taxable income on which corporate tax will be imposed. So again, that's also a part of the session. So I picked up a couple of slides from the previous session just to connect the dots also, because those are appropriate and there is no change happened on those sections. Now, what is corporate tax? Very simple. It's a direct tax levied on net income or profit of corporations and other businesses. Now, when we are saying about corporation and other businesses, we are including a level of natural persons also, and we'll see how those are spanned out, which is getting again covered. Corporate tax is sometimes also referred to as corporate income tax or a business profit tax. So these are different nomenclatures used in the various jurisdictions, but generally the the sense is equal to the tax on income of corporations or other businesses which is being earned. Why is you introducing corporate tax? There is a long history or long action plans which are part of it. Primarily, what happens? We live in a kind of a society. So all the countries when they put together, and all the countries when they put together and look at how these corporate tax is panning out. The society also derives like, are we doing best practices or not? So this is where the action plan is initiated into. So from a corporate tax perspective, if I say it's basically a regime of international best practices to strengthen the UAE position. Now, under what category we are putting up a position in a positive way? Primarily, if I just span it out, so anti-money laundering, and that's where the main crux comes into, and not using terrorism financing here as a part of a section, because that directly does not relate too much on the corporate tax. Primarily, what are we trying to save, or what are we going to protect from a global perspective is any kind of a tax evasion which is happening will be prevented from a UAE side. Yes, when you implement the tax structure, there are a lot of things also come as part and parcel of it. That means you are able to dictate all the corporates and the business houses to make sure that transactions history and audit trails or documentation trails are also being kept. So these audit trail or transaction history always support how these transactions can be visualized at a later stage where we have an issue or we need to assess, is there a money laundering happened or not? So it's a complete package. It doesn't come only from a tax collection perspective. It comes very heavily on the governance side also. We'll look at more in detail as we are going to talk about. So as we talked, primarily it's coming from a tax transparency perspective and prevention of harmful tax practices. So that is where this section or the corporate tax regime comes into. From when it will be effective, 1st June 2023. That's what we are having a target dates. Looking forward to the legislation, and maybe from that executive regulation or the rule book also is going to come up. Because normally for every corporate tax or any tax regime, you first have a legislation and then you have a rule. Why there are two documents? Because rule are more granular level. They give you the target values, the target transaction things from activity perspective. So if I just do a parallels with how VAT law has implemented, so again we have a law framework and we have executive regulation. We are expecting the same thing will apply from a corporate tax perspective also. So now there are some financial dates or financial years which are there. Just a very big snapshot. If your financial year or the financial year as per the constitution documents, make sure you refer to the constitution documents. I'm sure that you are referring that from an ESR economic substance perspective also, but it's very important to see that the date which you are using for ESR or going to use for a corporate tax is the same date which is there in the constitutional document. Generally, AOA, Article of Association, have those dates. So look at your AOA, MOA, and you will find what is the financial year. So if your financial year is July to June, then corporate tax will apply from 1st July 2023. If your financial year is Jan to December, then 1st January 24 is a tax applicability period starts for you. And if it's April to March, then 1st April 2024 is going to be a period. Generally, we have seen maximum people who are not having any financial year mentioned as a public consultation document is referred to, that Jan to December will be taken as a financial year. But it's always good to refer to the document which you have, and if required, you may need to amend the dates, especially if you're part of a group or you're part of a organization where you want to take a benefit of a losses from one entity to another. We're going to talk more in detail in those sections also, but I'm just connecting the dots wherever the slides comes into. Now, coming to the key principle, I think efficiency, fairness, transparency, and predictability is something which the Ministry of Finance wants to bring it up. They don't want to make it a very heavy kind of a legislation. but they definitely said that also, considering the nature of corporate tax, there will be some complexity, but as far as possible, the government is looking at how they can make it easy, simple, and transparent. One of the things which is being very clearly articulated in the public consultation document, that there will be a differential treatment, or you can say a differential submission of information, which will be there for SME and for non-SME. So a small corporates or a small entities and the startups will have maybe a less amount of information need to be submitted in comparison to the large corporates, because they know that compliance cost becomes heavy. And if compliance costs become heavy, the operational part becomes very difficult. So they are cognizant of the fact, and they're looking at that in a very effective way. Now let's jump into what we refer to flexibility and alignment with modern business. It's as simple as that. They want to look at how the globalization is working, how the technology integrations are working, and make sure that the data submissions are seamless. As we know, the regulatory authority expected to be the Federal Tax Authority, which is already having a key information on account of value-added tax. They have a key information on various other legislations, including economic substance regulation also, and hence there are connecting dots which are available. Now, how these connecting dots will be aligned, or you can say centralized, to make sure that not much of repeated information is being asked for. So that will be the goal setting process. So technically stating, tax systems need to be dynamic to keep pace with changing economic and social circumstances. We have seen last couple of years, the globalization has played a very important role. Initially, where you want to do business, you need to have a proper infrastructure, proper office, maybe people also. But that's not the case now. Looking at how we have opened up the things, or the information can be passed on from any location to another. SaaS technology, which is predominantly selling the software, has picked up very heavily on a lot of industry activity. So by sitting in one country, you can sell the product across the globe. So all those things are changing environments, and hence the regulators are looking at it. It is one of the biggest framework from an OECD perspective also, to look at how the tax evasions are happening by those large corporates by taking the shelter of the existing law. So I'll not say the corporates are doing something wrong from a legislation perspective. They're doing what is being stated. But OECD framework is looking at what are the gaps which need to be filled. So that's where they take, or they keep tracking the changing pace and how the social circumstances are changing. So that's going to be the key from a UA perspective also, and very clear. Certainty and simplicity, so that's where it comes into. So an ambiguity of the law, I think that's a biggest concern every businesses will have. So as there are, you can say, a pre-tax implication or advanced ruling kind of activity, which is currently applicable for VAT also, and excise also, may apply for the income tax or the corporate tax, as we're going to talk about. The rule should be clear and simple, so that business understand their obligation and make the right decision. And compliance costs are minimized. So that's where the commitment comes into. Whereas a certain level of complexity is unavoidable, which is also true, because we don't do simple business. So if you do simple business, the taxes are simple. But when we do complicated business, definitely there are intricacies. There are reasons why A company owns B company, and B company owns C company, and reverse C company owns A company. So there are a lot of planning also being done. So what we have seen in the VAT also, the business is simple, taxes are not very complicated. But if you complicate the structure, if you complicate the organization chart, definitely there are some kind of a clarity or more complications comes for a compliance perspective. So that's what Ministry of Finance is intended, and we are looking at it how these are getting implemented very effectively, because coming up with the consultation document itself is a big story, where they are approaching the organizations, the corporates, the consultants, and see how these can be aligned in a right way. Neutrality and equity is again one thing where the principle says that they don't want to overtax anyone and they don't want to leave out someone also. So a neutral principle comes as part of it. Tax rules should be neutral and equitable between different types and forms of businesses. Someone should not get a more advantage of being in some free zone or some location or some activity, and the other entity should not have a disadvantage. So those principles are being looked at, along with the underlying principles on which, example, free zone is established. So as we keep looking at as a consultant, also a lot of people ask, they're asking this question almost since I entered into professional career. What if I have a company in free zone and I deal with the mainland company? So we end up saying that your legal legislation does not allow you. However, the practice is being followed. So that's where the ambiguity comes from our side also. And we can't avoid it, because the moment we say no, you cannot follow, they come with examples and the stories which are there. But I think corporate taxes taking those pointers is a very effective way. Looks like we will have the right answers very soon once the corporate tax is looked at. So the objective is no business should have an added advantage because of their location or the type or the complexity or the simplicity, whichever comes into. So it has to be a neutral and equity-based taxation which comes into. Transparency, that's where I strongly believe that clear guidance and public communication is going to happen. We have seen in the previous legislation frameworks also. We are looking at in the non-tax legislations also, which is happening. A lot of sessions, seminars, open houses are being conducted by the ministries. Whether you talk about VAT, you talk about excise, you talk about AML, all those framework, you talk about ESR, all those frameworks, they came up with a communication channel. They came up with the information, which is quite rich to look at how we can comply to it. So those are some of the actions which need to be looked at from a tax perspective. Now coming back, this is what we talked so far on the hygiene from a taxation perspective, but what it tantamounts to, and how this is going to be applicable, or this is going to be adopted when we are following the corporate tax regime. Very important to understand what are the type of person for tax for which this tax is applicable. At the face of it, we see it to be a corporate tax, but no, there are some natural persons which are also getting attracted. When and how that happens, let's look at that in a more detailed way. So typically, type of person for tax implications are implementation is predominantly natural person and the legal person. We will break down what we refer to the natural person and where all this can apply to. There are fairly great rules, I will say, which has been come out. UBO, which is ultimate beneficial owner, is getting tracked at various locations or various sections, which is going to come up. So I will say having a right kind of a KYC, that is know your customer, is also becoming a part and parcel of the corporate tax, and how and what we will look at as we go along to the further slides. So natural person, the UAE corporate tax regime will be implementation without parallel tax on income of natural person, namely individuals. So you are technically not, first stance is individuals are not taxed. That's a first stand. Now, what comes within the scope of an individual, that is where it comes into. It says corporate tax will be applicable to all UAE businesses and commercial activities with an exemption. Now, that's the first underlying statement. Now, in order to have a level playing field between incorporated business and unincorporated business, that is where it comes into. If someone is having maybe a sole establishment, which is incorporated business, so it's still a licensed activity. The moment it becomes a commercial activity, a licensed activity, although it is held by individual, it comes into the ambit of corporate tax. So that's the first thing comes into. And in case there is an unincorporated business, in instances where the individual is not supposed to register, but he's doing a business, that means it's owned by the individual, UAE corporate tax will also apply to natural person engaged in business or commercial activity in the UAE. In the previous session, we gave some examples. If someone does a car trading, or someone does buying and selling of its own car, how we can differentiate whether this is a personal asset transaction or this is a business asset transaction. Very thin line, but very important to look at it. We have seen a lot of people do some part-time job on or some part-time activity on sale and purchase of exotic assets, which can be expensive watches, which can be expensive cars. Now, whether it comes in the definition of business or not, I think that's where the key comes into. If you can refer to the previous, as I said, video, which will give you an outlook of that. But just to give you a quick snapshot, if you are selling and buying your own car, that means you take a registration of a vehicle in your name and sell it, and it's not so frequent, then we may not call it to be a business. But however, if you buy a car and without taking a registration, that means RTA documentation, your name, and you sell that asset to another person, that becomes straight away a business, because you're not taking a possession, you have done a trading of activity of vehicle. So those intricacies need to be looked at. To not to complicate it, I think the simplistic way is to see whether the person has a license to what he's doing or she's doing, to whether this is bringing under the corporate tax regime or not. Now, this is what I refer to an unincorporated entity. So because the person is doing a business, but he has never structured or never took a license. Now, what happens if I pay income tax on those businesses? Will my license or my activity becomes legitimate? Again, the answer is no. Paying corporate tax or income tax does not, you can say, release you from the obligation which are done in other way. We have seen in other parts of the world, not too much in UAE as we talk, because we don't have too much of complicated taxes, where a person gets assessed on an income tax, and suddenly once the income tax assessment is completed or in the process, other sections or other regulators also come back and say that, hello, you have done either a money laundering activity, you are involved because the income which was not declared, it's a cross-border transaction, it has a forex involved, or you become into evasion of indirect taxes also. So I'm saying the next story is, if there is something wrong and you have paid the income tax, does not evade you from other sins or other activities which have gone wrong. Coming back to individual, where an individual is engaged in business that is subject to UAE corporate tax, would generally depend on whether activity require the individual to obtain a commercial license or equivalent permit. Now, what we are referring, we are not saying he has a license, it requires. So this is what we say, that if you are a tax person or you're obliged to be registered as a tax person, the tax will be applicable. From the relevant competent authorities, which can be a Dubai Economic Department or any free zone or Abu Dhabi Economic Department. So any free mainland companies or free zone, that is where the application comes into. It's very simple, but analyzing an individual and sitting with them and asking them what's happening is aligned or not. So one of the very recent case which I have encountered, and it's not to do with corporate tax, but it has a very good relevance. When people are changing the structure of any organization, they need to have change management very effectively now. What I've seen in one of the corporate, there were 6 companies which were all held by individual. These were sole establishments, a single person owning the company, all 6. And hence they were having one record from a VAT perspective, because it's a natural person by default, and all those companies are, you don't need to group it, and you don't need to create a group also. You just register one company, or you just register an individual, and you can comply and put up all the incomes in one bracket. But what happened, which is rightly done, to make it a corporate structure, they brought a family and they converted each entity into a LLC. Now they converted each entity to LLC, that is limited liability corporation or a company. They have not analyzed what is the impact on VAT for that, because the moment you convert into LLC, you are supposed to take re-registration of those entities, which is a different entity. And if you have 6 companies, you need to take a tax group also if you want to do it. So those are intricacies which I'm recommending people now to start looking at, not only sitting with a PRO or a company formation person and take an impact. You need to look at how you effectively see the change management, involve your tax consultants, involve your tax person, involve your accounts person, and then take decision, because it's not a single-sided transactional activities. So it's important what we do is right, and it's also important what we change is also aligned. So that's an experience which I'm just sharing it out with you. And I'm sure this is going to be applicable very heavily when the corporate tax comes, because a lot of things are implicated. What may not be taxable for a natural person? Now here, a very clear definition: any employment income. Employment income, again, is a very clear definition of employment. There should be an employment contract. There should be a work permit, which is there underlying. Don't consider a person on some other visa or some other activity or some other establishment and giving a salary, and they say, and you say that this is an employment income. That may be a consulting income or a professional income which you are paying. So look at from a holistic perspective. Dividends are again, if a natural person is receiving dividend, that's again, it's not within the preview from a taxation perspective. Rental receipt from UAE real estate investments and investment income. So investment is completely made out of the natural person taxation story. And there's a good leeway, or you can say good relief being given for a free zone also on some of the passive incomes, which we are going to talk about as we move along. The same treatment is intended to apply with where the UAE real estate and other investments are held through a private or a family trust or on behalf of beneficiaries that are natural person. Now, there are structures in UAE where people have created the trust or a foundation kind of a structure. Now, if you prove it out that these are from a beneficiary owner's perspective and this is a passive income, again, a beneficial or a benefits can derive out from those incomes which are being earned. Now, what's legal person? So again, there are various category of legal structure we can look at in UAE. Broadly, I can say a UAE tax resident can be broken into as a UAE company. When we say as a UAE company, we are talking about wholly, partly, or foreign owned by subsidiary of a foreign company or whatever we refer to. Joint venture of a foreign company also is again a UAE company. As a foreign company, it's a UAE incorporated branch office, UAE incorporated licensing office, in undertaking UAE based project with a PE from a UAE perspective. So here the PE becomes an important part. We'll dwell more into this because there are broadly three factors which we look at from a legal person perspective. First, is it a UAE company? That means does the corporate entity is being registered in a UAE? When we say UAE, UAE includes the free zones also. The other legal person is incorporated in UAE. If it's any other entity or a activity perspective. Third comes foreign legal entity that have a permanent establishment in the UAE or that earn UAE sourced income. Now, PE again is a big definition, and we are going to talk or develop out it how the PE can be established. There are multiple things which are looked at from a PE perspective, control, and how the people or the decision makers are sitting and where they are sitting. That defines whether the PE is met or not. Let's look at PE before we go into the corporate structure, because it's an important principle of international tax law. It's not something which UAE has adopted on its own. It's deriving from the OECD framework, and it's a very important principle from an international tax law perspective. If you look at various countries within Asian markets also has the PE concept, and they look at how those PE are met and established on a taxation perspective. That means taxing either the income which is earned within the UAE perspective, or you are going to earn the income from the global structure, how it is being adhered to. So the main purpose of PE concept is to determine if and when the company has established sufficient presence in foreign country to warrant the direct taxation of business profit of the company in that country. So we are talking about from a UAE perspective. Generally, a country only has a right to tax the business profit of a foreign company if that company has a PE in that country. So just to make it simple, if any entity has a permanent establishment in UAE and the control is met for all the businesses which are done from the various parts of the world, your PE is established in UAE and you may be taxed on the global income. Now, it's not as straight away as a global income being taxed. there is no double taxation. UAE is coming up with the giving a benefit of what taxes pay in the foreign country, but definitely the global income gets assessed. That's a right statement to use and how this is going to be impacting to. Now, permanent establishment from an OECD perspective. Now, this is the OECD framework which says existence of a place of business, that is the facility, such as premises, or in certain instances, machinery or equipment. So you may not have a premises, but machinery and equipments which are being placed in that location can also trigger the PE. The place of business must be fixed, that is, it must be established at a distinct place with a certain degree of performance. So if you are taking maybe a business center for a couple of hours or couple of days, may not attract it to be a permanent establishment, subject to certain other conditions being met. The carrying on the business of the enterprise through the fixed place of business, this means usually that person who in one way or another are dependent on enterprise, that is personal conduct of business, or the enterprise in the state in which the fixed place is situated. So it's not only about the place of establishment or a fixed place, it's a decision maker also plays an important role, whether there are right decision makers sitting there to take a decision from a global reference perspective. Now, the source of this document is also being mentioned in the slide, which I'm going to get at a later stage. So if you want to read up more, because I can't bring up all the elements of that OECD framework on PE's perspective. So hence this is a snapshot, but definitely it's a quite an important part, especially for the large corporates and multi-jurisdiction corporates, to look at in more detail to get into the place. Now, there are two major principles, or you can say are looked at from a permanent establishment perspective. First is fixed place of business test, and second is dependent agent test. So both these points are important. If any of the test gets met, your PE gets triggered, and hence the implication of the tax implications comes and plays an important role. You may have instances where an entity does not have a corporate structure or a company or establishment in UAE. Still, they may get attracted to the corporate tax of UAE. That is where the catch comes into, and that's where it's important to see how these both elements are being looked into. Now, fixed place of business test. Again, the pointers. One, the fixed place of business will include the place of management, a branch, an office, including temporary field office or an employee home office. So if you don't have a fixed office, we can't say that we don't have anything. But if an employee is there and it is stated that all the work is done from the employee's home office, then also it gets attracted. A factory, a workshop, a real property, and a building site where activities are carried out for over 6 months. So if you've taken a subcontracting kind of activity and the activity is being undertaken for 6 months or more, that also picks up the positive test on the fixed place. Installation and structures used in exploration of natural resources as well as mines, oils, gas wells, quarries, and other place of extraction of natural resources will also be considered P. UAE generally don't have these kind of instances because for doing all those activities, you are supposed to have an establishment, you are supposed to take the license, but in case you are acting as a subcontractor also, then also, and you're a foreign company, then also all these things gets kicked in. I see a very limited scope of this definition, but still it is applicable and need to be tested for any foreign entity working or supporting any business in UAE. It may tantamount to be an import of service, but it may attract a corporate tax also for that foreign company. Now, fixed place still may not consider as a PE. So you may have a fixed place, but still you will ignore it from a PE perspective. Now, 2 pointers they clearly referred. Activity in preparatory or auxiliary in nature. That means you're not doing a direct activity or a pure marketing or a promotional activities, which we generally call as a rep office, representative office. So in that case, you may have a fixed place, you may have an office structure, but you may not get attracted from a corporate tax perspective. So activities performed in preparation or in support of more substantive business activities of the foreign company Example, limited marketing, promotional activities, performing marketing research, and attending seminars or conventions. So generally, if I say a rep office is what this falls into this category. And although you may have a PE, generally in this case, if you look at prospectively, these are cost center. These are not the income centers. You don't earn any income generally in the rep offices, except for the money which is being transferred from the head office or the parent entity. A fixed or permanent establishment in UAE is used only to store, display, or deliver the foreign company goods or keeping the stock of goods with the sole purpose of making them available to another person for processing. So in this case, you are technically not selling. You are more a kind of a reprocessing activity. Again, in this case, you don't have any source of income, technically speaking. It's more a cost center. So if you look at the exempt activities are more a cost center activities than the profit center businesses. Now, next test which we talked about is a dependent agent test. Now here there is a good catch which comes into. So a lot of time there are business travelers who come to UAE and look at how the businesses are done. So those are getting attracted. That means agent principal relationship is becoming quite important to understand in this section. In the absence of any fixed place of business, that is in the UAE, the activities of so-called dependent agent in the UAE could still create a PE for foreign company in the UAE. So if you don't have a fixed establishment, but you so-called work through a dependent agent, then also the PE may get attracted. Now the dependent agent may be met where business traveler or UAE-based person act on behalf of the foreign company in the UAE and have habitually exercised the authority to conclude contract in the name of a foreign company. So if you are having someone who is coming to UAE frequently, doing a business, doing a negotiations, doing an activity as a principal, not as an agent. If you're doing as a principal, the corporate tax may get attracted through the PE establishment. Now this includes situations where the person negotiates or concludes contracts in the UAE on behalf of a foreign company without material intervention from non-resident company. So now PE would not arise where a person carries on a foreign company business in the UAE in an ordinary course of their own business. Now, if so-called independent agent exclusion would only apply where the person does not work exclusively for the foreign company, is truly legally and economically independent. Now, this more referred to a consulting kind of activity. Let's say example, there is a foreign company has hired a consultant to do some kind of a research or help sell their product. Now, when they're selling a product as a principal or as an agent, that plays an important role. If you're selling a product as a principal, you may get attracted through the dependent test. But if you are acting as an agent, then it's a very different action plan which comes into play. I'll just again repeat the point, which is very important here to look at. Now, in this case, if a consultant is working for a foreign company, example, I'm a consultant and I'm working for a foreign company. However, I am independent. I'm not at all executing any transactions on behalf of a foreign company. I am only negotiating. I'm only acting as part of my other ambit for that foreign company. In that case, the dependent agent test does not pass. So very important thing to look at. Agent principal relation is an important part here, which we need to look at whether foreign company is getting represented or foreign company product is getting sold indirectly through the agent. So this is where the dependent test comes into play. So if a foreign company does not have an agent, they may get attracted from a PE perspective since they are executing the transactions directly and on their own. So that is where the dependent test comes. So it's very important for foreign companies to assess it if they don't have an agent or any principal office in a UAE. Now, from a corporate perspective, again, one of the critical point comes as a free zone. So we looked at, just to maybe give a quick recap, we looked at P, which is important for an entity which is not having an establishment in UAE. does not have a trade license, does not have a commercial license, then the fixed place of business test and dependent agent test comes into play. You may not have your own office space, but an employee who is permanently working here and is a decision maker equivalent may attract permanent establishment. Again, dependent agent, you don't have an agent, but however you're doing a business in UAE directly and executing contracts in UAE without having an intervention from the parent company, you may pass on the dependent agent test and get attracted to the PE. So that is where the genesis comes into. A lot of I think when the legislation comes, a lot of pointers will get more articulated in this section, but it's a important part, especially for the foreign entity. Now looking at a free zone and mainland. So now there are some interesting principles, because there's always we refer everything as a black and white, but that's not how the life is. So there are a lot of grays in this section. The same P rule and the principle will apply to determine whether a free zone has a P in the mainland UAE or not. Now, it's important to see how you and where you take decision. A lot of time we have a free zone companies and we have an operating address which is taken by one of the group company, and we show it in the mainland. So again, the P rule comes in this category also. So it's not only for the foreign entity. A free zone PE rule is also important. Now there is an exemption which is given from a PE perspective, which is predominantly on investment manager exemption. UAE corporate tax regime will allow regulated UAE investment managers, which is predominantly central bank approved or ADGM approved or DIFC approved investment managers we are talking about, to provide discretionary investment management services. Now, this is very clear. This technically attracts into the PE side, but they have given a very clear exemption. Now, if you see, discretionary investment management is a form of investment management in which buy and sell decisions are made by the portfolio manager for the client's account. So that means you are acting for and on behalf of a client, so which can be constituted as a dependent agent. But to make it clear, they have given a very clear exemption. So all other dependent agents are part of the PE principle, but this is being taken out as an exemption. Now, discretionary investment management services to foreign customers without triggering a UAPE to foreign investor or the foreign investment fund. The exemption will be subject to conditions that are comparable to similar regimes in the leading financial center. So again, it's a kind of a treaty. Which country gives us a benefit? So we have a bilateral transactions or bilateral actions on these trades. Similar principle we have seen the VAT also, where VAT refunds are allowed to the foreign entities, subject to the similar principles are used in those countries also. So it's as simple as that which is coming up to. But a very clear example, a discretionary investment again is a part of a dependent agent, but exemptions being given from will be given from a UAE corporate tax perspective. Coming back to legal person, now legal entity or deemed legal entity. So both are part of it. What we referred so far, let's again re-emphasize and restate. A legal person include any LLC, limited liability company, private shareholding company, public joint stock companies or entities established under the law of UAE that has a separate legal personality. Legal person incorporated in foreign jurisdiction that are effectively managed and controlled in UAE. So that's where it comes back to the PE principle. Limited liability partnership limited by shares or other type of partnership where none of the partners have unlimited liability for partners obligation or other partners action. Now this is very interesting. We will connect it to one pointer. If you see the last point, partnership, it does not cover the unlimited partnership in the section of legal person. Now, should we say that unlimited partnership people are not covered as a corporate tax? Answer is no, they are covered, but in a different principle. They are covered under the natural principle. Legal person is not covering unlimited liability partnership. So again, just the last point is, I think, the biggest commentary I have in this slide. All partnerships are covered except for unlimited partnership. They are not considered a legal person. They are considered as an individual. So there is something called transparent organization structure or transparent ownership structure, which will be followed for unlimited partnership organizations. So that's a pointer you need to take it from this slide. Very important part. Now, limited and general partnership and other incorporated joint venture and association of person will be treated as transparent. Now here we are talking about transparent means they will not be taxpayer on their own right, but their income will instead flow through and be taxed in hand of partners or members. The only flow through treatment is widely recognized and accepted internationally and also ensure tax neutrality for investors in collective investment funds and other structures are limited as a limited partnership. So in this case, if you see what happens is if there is a fund which is under the association. Now, association does not get taxed in this case, but the individuals will be taxed on respective incomes which are earned from that association. That is the difference which comes into this structure, where we say that it becomes a transparent. That means you ignore the corporate structure or the association in between and straight through pass through and see the owners and tax them directly. Quite beneficial because every individual may get a benefit of a threshold or slab, and hence it will be a quite a structured approach to look at this in a good way. Important tax implication to be assessed. Investing in and through unincorporated partnership in a cross-border context are create difficulties and unintended tax consequences. Now, why it creates unintended tax consequences? Because every country may have a different tax treatment. So it's important to look at if it's a foreign entity, where it is located and what is the tax treatment. Is it becoming neutral or not? If it is not becoming neutral, then again, one of the important part to look at how pre-planning can be done and structures can be aligned into. To align the tax treatment in partnership in cross-border context, the UAE corporate tax treatment of foreign unincorporated partnership would generally flow the tax treatment to the partnership in respective of foreign jurisdiction. So there can be instances where unincorporated partnerships are taxed as a corporate. There are instances where unincorporated partnerships are treated as a transparent. So if you have different treatments in various different countries, important to look at the structure and reassess so that you don't get double taxed. So this is maybe one of the important part from a legal personality perspective to look at, and if it is there, then time to do some pre-planning. Now we talked about who are going to be taxed. Now there is one good section which is going to be exempt, also are considered as exempt person. The following person will be exempted from corporate tax either automatically or by the way of application. Now, first is federal and Emirates government. All government authorities are either they are exempt or they will have a special provisions through which exemption will comes into. Wholly government-owned UAE companies that carry out a sovereign or mandated activity and that are listed in cabinet decisions. So again, government entities we are referring to. Businesses engaged in extraction and exploration of UAE natural resources that are subject to Emirates level taxation. So we refer to all the natural resources extraction companies are subject to Emirates level taxation, and hence they may not have a taxation at a federal or you can say a corporate tax level. Charities or other public benefit organizations that are listed in cabinet decision. Public and regulated private social security and retirement pension funds. Again, these are made as out of the UAE corporate tax. Investment funds subject to conditions mentioned. So now there are conditions which will come for the investment funds also, where you may look at how those are going to be exempt. So there is going to be exemption with condition or with reference points which will come in. From investment fund perspective, again, we refer to are commonly organized as limited partnership to ensure tax neutrality for their investors. The tax neutrality follows from the fact that most countries treat limited partnerships as transparent. Now, what we refer to normally that partnership forms are considered as a transparent partnership. We're talking about limited partnership. We're not talking about limited liability partnership. For domestic and international tax purpose, which puts investors in the fund in a similar tax position as if they have invested directly. Just 1 minute, let me mute them. I can't see who is. Okay. Okay. Sorry for this disturbance. So investment funds. So this is again coming back from a thing which we talked about, whether these are considered as a transparent or not. So if these conditions are met, then investment funds also may come out of the ambit of a corporate tax structure. However, the individual may get attracted from a taxation side. Regulated investment fund and real estate investment trust can apply for federal tax authority. That means a tax regulator to exempt from a UAE corporate tax subject to meeting certain requirements. Now there are certain requirements which are being defined. One is the investment fund is regulated by a regulatory authority in UAE that is recognized by Ministry of Finance. So either it should be under SCA, Security Commodity Authority, FSRA, which is a regulator for ADGM, and DFSA, Dubai Financial Services Authority, which is a regulator for DIFC. So if these funds are regulated from them, then yes, they can apply. No group of 5 or fewer investors and has 50% or greater economic interest in investment fund. That means when you add up 5 people, they should not have more than 50% of the economic interest, and no single investor has 20% or greater economic interest. So if these categories are being followed, and interest in investment fund can be freely traded in the stock exchange in the UAE or recognized foreign stock exchange, or widely marketed and made available to the intended category of investor, not to the all intended category. So there can be funds or investment funds which are only for professional investors having some category of income or category of wealth. So if these categories are met, then it's not a by default exemption, it's an application based exemption. So the basic principle is it's freely tradable within the intended category of investor. No single investor has more than 20% or greater economic interest. 5 people or group don't have more than 50% of economic interest and recognized under the SCA, FSRA, or DFSA. So this is again on application based, not by default. I'll give a short pause here if there is any question from anyone. Okay, I'm not looking at the chat window or anything right now. Maybe we'll look at that after half an hour. Going back, because the content is quite heavy, so we are still 34 slides down, and 1 hour is already over. So tax implication for a free zone. Now this is an interesting part which comes into as a free zone has given a long-term tax benefit. Example, if you look at the ADGM website, it says that ADGM provides with 50 years 0% corporate tax holiday and access to an extensive network of double tax treaties. So, and DIFC says it provides 40-year guarantee of zero tax on corporate income and profit. So basically, DIFC is 10 years older. I think that's where the things comes into play. But still, 40 to 50 years of tax holidays are there from a corporate tax perspective. Now, how this will span out and what will be done. So from a regulatory perspective, it is clearly mentioned that free zone business will be subjected to UAE corporate tax. But now this is where the interesting things come. The UAE corporate tax regime will continue to honor the corporate tax incentive currently being offered to free zone business that comply with all regulatory requirements and that do not conduct business with the mainland UAE. Now, this is an interesting point which comes into now what is tantamounts to a mainland business or what is tantamounts to a UAE business is an important part. So I'll say first thing, every free zone should maybe give up their import licenses to import the goods from the mainland if they want to get a benefit of this category. So that's the first off-cuff information which is there. But looking at most of the free zone in UAE, if not all, I have not looked at all the AOA, MOAs and the constitutional documents. They do not permit a company registered with such free zone to do business outside the free zone. They're allowed to do business outside the free zone, but within other free zone of UAE, that is fine. But they're not allowed to do business outside the free zone mainland unless company obtains appropriate license from local authorities. So when you are obtaining a license from a local authority, that is, let's say you are obtaining a license from Sharjah Economic Department or a Dubai Economic Department, then you technically are creating a pseudo PE from an organization perspective or from an entity perspective. So again, go back to the PE section, re-review that, and then look at are we aligned or not. Now, obligation for free zone companies, a business established in free zone will be required to register and file for corporate tax return to claim the benefit of no or lower tax application. So right now we're talking about a zero tax for the measure of the income. So it's not that free zones are out of the corporate tax regime. They are definitely within the corporate tax regime, but they get a benefit of 0% taxation. No different treatment for different free zones except for the financial free zones, and that's actually not the financial free zone exemption, that's a income category exemption. So in a nutshell, if you see, there is no special treatment being provided here for any free zones. Yes, you will get some more benefit if you are a designated free zone from a VAT perspective, and we'll look at that as we move along in few slides from now. Now, first premise, 0% corporate tax on income earned by free zone. So that's a first premise which is there. Now, this premise comes with certain clauses or certain sections which need to be adhered to. A free zone person can benefit from a 0% corporate tax on income earned from, first, transaction with business located outside of the UAE. That means no business in UAE. Transaction with business located in the same or other free zones. That means, again, no business with UAE mainland. Third, the 0% corporate tax may also apply to income from certain regulated financial services directed by at a foreign market. So we referred that in the previous section also, where we said if these are regulated markets, certain conditions are met, then you may get attracted into a 0% corporate tax. So very effectively, if I just say off cuff, I'm not putting all the entities in one bracket. Major of the DIFC and major of the ADGM entities may get attracted into the 0% section. But again, this is the financial services which we are talking about. So if you have any other company, any other structure in DIFC, ADGM, you may get attracted on a corporate tax. Not you anyway are attracted to a corporate tax, but at a standard rate, which is a 9%, not 0%. That's where it comes into. Let's peel off more. What if a free zone person that has a branch in the mainland UAE? So entity is mainly in free zone and they have a branch in mainland. So a taxed at a regular corporate tax on the mainland sourced income, which continue to benefit from 0% corporate tax on its other income. So if you have a branch in mainland, identify separate profits, separate financials, and pay a regular corporate tax, which is 9%, while you will definitely get a benefit of 0% corporate tax in the other income. That means in the income which is earned in the free zone, subject to, again, other conditions which you're going to look at. Free zone person transact with mainland UAE, but does not have a mainland branch. Now, in this case, you don't have a mainland branch, but still you are transacting with the mainland entities. Now, free zone person can continue to benefit from 0% corporate tax if the income is a passive income. Now, what is passive income? Royalty, rent, dividend. If you are earning those kind of income, then only you will enjoy 0% corporate tax. So only income which is allowed to be taken from a mainland office or a mainland entity is related to passive income. Free zone person can continue to benefit from 0% corporate tax if its income from mainland UAE is limited to passive income. This would include interest, royalty, dividend, and capital gain from owning shares in mainland UAE companies. So if any of these passive incomes which are there, then it is considered as 0% corporate tax. Now there will be a more clarity which is required on the real estate side. Will that be considered as a passive in this category by entities which are holding the properties or real estate? We need to get some more clarity on this section. Ideally speaking, rentals are considered as passive income, but this is not very clear on the sections which we are referring to. So that's again one open point which will have more clarity as we go along, and we'll get into some more additional information when the legislation comes out too. Now there is a group transaction. Now there can be a possibility of a group transaction. Now what is the definition of group? How it comes into? Again, we are going to refer to a few slides from now. Group transaction between free zone person and its group company. That is, it will be a 0% corporate tax. Will apply to transactions between free zone person and their group company located in mainland UAE. However, now there is a however they have done, which is to ensure corporate tax neutrality. In each transaction, payment made to free zone person by mainland group company will not be a deductible expense. So you have called it a 0%, but you are negating any payments made. So you're eliminating the whole transaction, but still they are saying it's okay because this is a group company. So what you had given so far, if you see, the benefit is given where you have a branch in the mainland of a free zone company, you're fine. You earned a profit or income in the free zone from mainland, but which is limited to passive income. I'm not commenting right now whether real estate will come as a passive income or not, but what the definition very clearly says, interest, royalty, and dividend are definitely considered as a passive income. Next comes any group transaction. If you're doing, they're saying still you claim 0% tax, no issues, but you remove the payments which is made to the free zone by mainland company. We will not allow that as a deductible expense. So that expense has to be taken back into the income side. Now this section is again, as I referred to, there is a special provision being given for VAT designated zone companies. Now I'll use a word, it's not a special permission or a special condition, but it's giving a neutrality impact of how the transactions are done. So the section says a free zone person located in designated zone for value-added tax purpose can benefit from 0% corporate tax on income from sale of goods to UAE mainland business that are imported on record of those goods. So technically, if you are selling goods in free zone, and UAE mainland company takes their importer code to import the goods in UAE mainland, from a free zone perspective, it is considered as goods sold in the free zone only. So that is a premise which is being taken. So anything which is pre-custom border or where the custom duty is not paid, if that is transacted from a goods perspective, it is considered and the benefit of 0% corporate tax will be allowed. So this is what I was referring to. If you are doing a trade between mainland and free zone, that means you're selling goods from mainland to free zone. First thing from a corporate tax perspective can be looked at immediately is giving up your importer code. That means not importing the goods on your importer code in the mainland. So this will help you to get a benefit of 0% corporate tax. I'm sure there are certain other dilemmas or action points we need to look at, whether it's okay to be 0% or 9%, that's a different decision. But this is one of the points which can be quickly looked at and assessed to, so that you start practicing now. Because one transaction may spoil the whole corporate tax regime or corporate tax discussion itself. So that is where the challenge comes into when we look at it. Summary. We talked about a free zone person have a branch in mainland UAE. What treatment is there? Income from mainland UAE is limited to passive. Transaction between free zone and other group companies located in mainland allowed, subject to some payments not being allowed as expenditure. A free zone person located in designated zone, we looked at how he can claim a 0%. So these are 4 pointers which are being given. Now, apart from that, that's where the interesting thing comes. To prevent free zone business from gaining an unfair competitive advantage compared to business established in mainland UAE, any other mainland sourced income, any other. So if you have any other income other than these 4 categories which we referred to, will disqualify a free zone person from 0% corporate regime in respect of all their income, in respect of all their incomes, not only for that income. So one transaction may spoil the whole 0% ambit itself. So that's quite straight through and quite harsh. Let's see whether the legislation also comes in the same line or not. So just a snapshot again, as I referred to, a free zone have a branch in mainland. Perfect. You have a income breakup. You pay taxes on the branch and mainland, and the free zone company can enjoy 0%. Any passive income in the free zone from mainland is perfectly fine. Transaction between free zone and the group companies located in mainland allowed, but again, this is between the group company. What is the definition of group company? We're going to refer to. Subject to you don't claim some expenses, designated zone VAT principle. So if apart from this you earn any income, when I say any income, maybe I can take an example where you have imported, that means the free zone company is an importer on record and sells the goods to the mainland, the whole income story or the whole tax story will change. It's not one transaction, everything will change immediately. Good slide to ponder and absorb too. This is my Eureka moment when I was reading the consultation document to see, okay, wow, this is something very interesting and need to be quickly looked at in a very, very detailed way while planning. Very important to start the planning now, because any one transaction miss out at a later stage may completely change the whole story of the tax regime. Perfect. So where a free zone person benefits from 0% corporate tax regime in respect of mainland source income, such income will be within the scope of withholding tax to be applied at 0%. So now here, wherever the taxes we talked about, it's a 0% tax, it's not exemption. So it's interesting to see because if you have a 0% tax, you are still subjected to tax. So that's the important part which comes on a DTA, double tax avoidance agreements or double tax treaties. 0% taxation is still a taxable income, and exemption is a non-taxable income and may have a very different treatment. So that's a catch point. I will use a word. So when you see 0, don't assume it to be out of taxation. It is taxed. As in VAT, we keep looking at whether it's a 0% tax or exempt. Exempt don't get a benefit of input tax. So here also 0% tax gets a good benefit. Out of scope or exempt does not get that benefit. So just a quick snapshot. Now, what if I want to pay tax in free zone? No problem, you can pay. No one is stopping you. A free zone person will at any point in time be able to make an irrevocable election to be subject to the regular corporate tax rate. You want to pay corporate tax, no problem. But important point is irrevocable election. So once done, that's it. You cannot change it. So that is the important point to look at. There are instances where people will say, I think I'll be more comfortable in paying 9% taxes than creating the documentation trail and all those things which are required. So it's up to you. It's up to the free zone companies how they want to plan it out, how they want to execute it. But the section is very clear. Once entered, there is no exit way. Recap. Very good, I'll say, chart which is being given by the consultation document also. So if you look at a very specific thing which comes into who is a legal person, first definition comes a legal person incorporated in the UAE, a legal person that is not incorporated in UAE but is effectively managed and controlled in the UAE, so PE concept. A natural person engaged in business in the UAE. So which we refer to need to have a license and all those category comes into. If answer is yes, is the person UAE? Now these are exemptions. So if you are a UAE federal or UAE government, wholly owned UAE entity, we talked about charity, public regulated private social security or a retirement fund, and regulated investment fund we talked about. So these are exemption category. If these are exemption category, remove out. If yes, then there is no taxation. The person will not be subjected to corporate tax. If it's a yes, then person will be subjected to corporate tax. Coming from the top side, if you are not a legal person, that means you are a foreign entity and have a permanent establishment. If you have a permanent establishment, come up, you become attracted to taxes. If you don't have a permanent establishment, also, does the person earns UAE sourced income? If answer is yes, again, the person will be subjected to UAE corporate tax. Now, again, the pointer comes into whether the corporate tax is subjected to 0 rated or 9%. We are not debating or deliberating right now. We'll get into that also, but will be subjected to UAE corporate tax. Now, who is considered as a tax resident for UAE corporate tax? Again, some recap only. So there are 3 categories: legal person, natural person, foreign company. This is what we referred to so far. Just trying to bring up as a one slider, so we have a complete ambit. Legal person, a person that is incorporated in the UAE. Natural person, any person who is engaged in business or commercial activity in the UAE, either in their own name or through an unincorporated partnership. Foreign company, a foreign company may be treated as a resident person if effectively managed and controlled in the UAE. So the 2-pointed test which we looked at, one is dependent agent test and the fixed establishment test. So both has to be looked at. Determine whether the entity is effectively managed and controlled in the UAE is a question of fact, but would typically look at whether the director or the decision maker of the company make the key management and commercial decisions. So that is where it is now becoming very important to make sure where the board meetings are conducted, who are the decision makers, and what are the action plans being taken. So if the board meetings are conducted in UAE, have the critical decision-making pointers in that, it becomes an interesting point for a foreign company. Now, the critical points which I have highlighted: legal person, look at incorporated location. So if it's UAE, perfectly fine. Natural person who is engaged in business or commercial activity, it comes into. Foreign company, if it's effectively managed and controlled in UAE, effectively managed and controlled comes to director, decision makers, where they're based. So these are the broad points which comes into. Now, how the tax implication looks like: legal person will be taxable in UAE on their worldwide income. Now, the worldwide income is a good action plan. So, what happens to the worldwide income? What kind of a benefit you will get on a foreign taxes paid? We'll talk about that. But one critical thing which I see here is your financials, your database is completely open from our UAE regulatory authorities on the income which is earned globally. Whether you end up paying taxes or not is a different discussion, but definitely the information, the openness or the transparency becomes quite effective and active in this case. Natural person, you may have worldwide income, but it does not get attracted if you're a natural person. Limited to income earned from their business activity carried out in the UAE. So the worldwide concept does not come in the case of a natural person, but again, foreign person, again it comes. Will be taxed on the UAE, in the UAE on their worldwide income. So why we are referring to a foreign company and a legal person? Because their control, their key stakeholder, key management, all those things are getting triggered in UAE, and hence it is attracting the worldwide income. But natural person, it does not happen. So benefit, or you can say a differentiation between a sole establishment and a LLC. This is where the one big difference comes, where a sole establishment is considered as a natural person, hence there's no question of worldwide income, so you get restricted within UAE. But a LLC kind of a structure or a foreign company kind of a structure, you get assessed on the worldwide income, which need to be looked at. a slide to important, I will say, analysis from the constitution, from the consultation document. Okay. So this is again coming back, except for exempt income, which you are anyway moving it out, where the income earned from abroad is not exempt. Income tax paid in the foreign jurisdiction can be taken as a credit against the corporate tax payable in the UAE on the relevant income, or to prevent double taxation. So again, you have to, if you are having a foreign income, that the calculation of taxes also is going to be very different. We are going to get a little more detail in the further slides, but very clear, your worldwide income is assessed, you get a benefit of what taxes you paid in the foreign jurisdiction. Now, what happens? What about non-resident? Again, going back to the PE side, taxable income from permanent establishment in the UAE will be taxed, and income which is sourced in the UAE will be taxed. So that is a non-resident. So non-resident will get attracted on the taxation side very clearly. P, remember we referred to fixed place of business and dependent agent test, just to bring it back again to show you what we referred in the previous section. Now, what happens to the UAE source income? Now, every UAE source income may not be 9% taxed. It can go and attract towards a 0% tax also. So UAE source income earned by a foreign person that does not have a P in the UAE will be subject to withholding tax at a rate of 0%. Now, this is interesting. Income is earned by the foreign entity who does not have a P. If we have a P, then you automatically get into a standard corporate tax story. But who does not have a P, then there's a withholding tax at a rate of 0%. Now, why they have brought up withholding tax of a 0%? Reason can be this can be amended. So legislation is there, rules are there. So whenever you want, you can maybe upgrade this tax at a later stage if required. Right now, it is 0% taxed. Again, as I said too, the benefit of subjected to tax or exempt or no tax is having a different implication on a DTA, double tax avoidance agreements, or double or dual tax treaties. So which also need to be assessed on a country level and see what kind of a benefits can be achieved if the withholding tax is already being deducted at 0%. Now, UAE source income earned by a foreign person does not have a P in UAE will be subjected to withholding tax of 0%. That's what we read. Zero tax is also a tax and may be classified as subjected to tax. So this is a key point, and it will have a good implication on an international or the worldwide tax